Hollywood tells us there's a few ways to travel through time. A hot tub, a spinning phone booth.
Are you telling me that you built a time machine? Out of a DeLorean?
But in real estate, we have something that's just as exciting and way more useful. Assumable loans. Today on the State 48 Homeowner Podcast, we're diving into one of the most powerful and underused tools in the market. We're going to show you how they work, how you can take over someone's low rate, how you can skip the usual lender fees, and how you can save hundreds of dollars every single month for the life of the loan. We're going to walk through real life examples right here in Arizona. We're going to get expert insights as well. Now, if you like this video, leave us a like, thumbs up, it really helps. Now, let's show you how to time travel without leaving the present this week on State 48 Homeowner.
Hi, I'm Klaus, and this is State 48 Homeowner.
Now, in a typical home sale, the seller pays off their mortgage and the buyer starts fresh with a brand new loan, often at whatever today's rate is. But what if the buyer could take over the seller's existing mortgage instead, with their original interest rate, loan balance, and terms intact? That's what an assumable loan is. Certain loan types, specifically VA, FHA, and USDA loans, are assumable, meaning the loan can transfer from one qualified buyer to another. The rate, the monthly payment, the remaining loan term, the amortization table, all of that stuff stays the same. So if the seller locked in at a rate of like 2.25 back in 2020, and today's rates are like 6.5, you can see the appeal.
Right now, assumptions are the most underrated tool in the real estate market. They really are the biggest win-win right now. You have buyers that are able to get lower interest rates, meaning lower payments. Sellers have a much larger buyer pool that can look at their assumable homes, and they're able to get faster selling times, and they're also able to get usually more money for their home. It really is a huge win-win.
Now let's bring this all down to real numbers. At 2717 West Medina in Mesa and Dobson Ranch, we've got a 3-bed, 2-bath home with a pool and a VA assumable loan at just 2.375%. The balance is about $214,000 and the home is listed in the low 500s. Now over in Chandler and Ocotillo at 2000 West Periwinkle, you could assume a 2.25% VA loan with a balance of $314,000. That home's listed in the mid 500s. Then we have 1170 East Jardine in Casa Grande. It's a 3-bed, 2-bath home with an FHA assumable loan with a 4.75% rate. But it's got a purchase price of $325,000 and the FHA assumable loan has a balance of $313,000. So the delta there's only $12,000. So how do you cover that difference, that gap or the delta between the low balance and the purchase price? There's two options. One, you can pay the difference in cash. Two, you get a second loan at a higher rate. Now, option one's the best. And if you've got a suitcase of cash, or if you've got an investment that just matured, or maybe you just sold your home and you're coming in with the proceeds, or maybe you just put it all on red. I don't know. If you've got the cash, just use that cash to cover the delta and enjoy the assumed rate and all those nice terms. But most people don't have the cash for some of these assumptions. Now, some deltas are small, like with the home in Casa Grande, with it's only $12,000, but some of them are larger. And for those that need financing to cover the delta, let's look at option 2. And this is where you would get a secondary loan. It's a second mortgage to cover that delta. Now, second loans are generally at about a point above market rates. But when you look at the big picture of having the two loans together, you have what we call the blended rate.
So effectively how that works is you have let's use an example of a $500,000 sales price and a $400,000 assumable loan. Now you don't have $100,000. So what you can do is you can put 10% down, let's say, of that $500,000 sales price, so $50,000, and you can get a second mortgage for the other $50,000. Now that second mortgage interest rate, people will ask is like, oh, those interest rates are so high. Well, yes, it might be 8% or 9%, or let's say it's even 10%. But if you have 2.875% on 400,000 and you have, say, 10% on 50,000 and you do the weighted average of those two, you're probably sitting right around a 3.7% interest rate. So would you rather go to the regular new financing market and get 6.5%? Or would you rather take the blended rate of 3.7%? Take the 3.7%.
All right, let's say you buy Periwinkle. You assume the $314,000 loan at 2.25%, and you get a second loan for $180,000 at, say, 8%, and you put 10% down. Your blended rate, it's still around 4.356%. That's way lower than getting one big loan at 6.9% or more. The difference in payment between option 2 and a regular 10% down conventional loan on this home would be about $620 a month in just principal and interest. The savings add up. And there's no PMI on this loan assumption, but there would be on a conventional loan with 10% down, right? Hundreds of dollars saved every single month on the loan. Another cool thing is you bring along the amortization table. Now, the amortization table, it's a big nerdy spreadsheet that calculates how much of each payment goes towards principal and how much goes towards interest. So in the beginning of the loan, it's mostly interest and very little principal. And at the end of the loan, it's mostly principal and hardly any interest. The lender wants to get their interest at the front of the loan, especially if people are going to refinance or sell. Makes sense. They want to get their money. So the bonus in the case of the periwinkle assumption, they're 5 years into their 30-year loan. So you're stepping into a loan that's already 5 years deep. That means the amortization schedule has already shifted a little bit towards paying down more principal in each payment. In other words, more of your payment is going to equity and less to interest than it would be in a brand new loan. One final plus that most people don't consider. VA loan assumptions don't require the buyer to live in the home. Investors are eligible on VA assumptions. That's different from a FHA loan, which requires the buyer to be owner-occupant. Investors can enjoy that historically low, super low financing, sometimes the math on a pro forma will work at 2.25%, where it wouldn't at 8.25%. So if assumables are such a good deal, why isn't everybody doing them? Well, there's still a relatively unknown strategy. And it really does sound too good to be true, right? And so a lot of people are going to discount it for that reason. And there's also a couple catches. First, the loan has to be assumable for you to be able to assume it. So VA, FHA, or USDA. Now in Phoenix Metro, not a lot of USDA loans, so it's generally only going to be a VA or FHA loan. All VA and FHA loans are assumable. It's in the language of the loan. Your servicers might tell you otherwise, but it is assumable. Now, if it's conventional, it's not assumable. Second, the buyer has to be approved by the current loan servicer. That's who holds the mortgage. That's who's going to review the financials. And keep in mind, while you don't need to be a veteran to assume a VA loan, the seller will have to agree to sell to a non-veteran because they're going to have to give up some of their VA entitlement in the process. But it never hurts to ask. They may not be planning to use it. Now, you are also going to need to prove income, creditworthiness, and ability to repay, just like a normal loan. Now, third, assumptions can be slow. Unlike a traditional loan that might close in 30 days, assumables often take 60 to 90 days or more, depending on the servicer. Now, some servicers are great and quick. Others, you're going to feel like they're sending documents by carrier pigeon. Loan servicers don't always make the process easy. Some of them are going to drag their feet because, honestly, they're making less money processing assumptions than originating new loans. But don't let the timeline scare you. With the right partners, and we work with excellent partners, groups like UME Projects and ROM, it can be done.
There's actually more than 12 million loans in the US today that are fully assumable, and 4.8 million of those come with an interest rate below 3.5%. So that means there's about 5 million chances to get somebody into a rate that is about half of where today's prevailing rates are at 7%.
Now, here's why this works so well in today's market. Over the past 10 years, single-family home prices in Maricopa and Pinal counties have soared from a median of $209,000 to $490,000. That's $281,000 in equity gained. But rates have been all over the place, from the 2s to the high 7s, and that's put the brakes on a lot of buyer activity. But assumable loans are a great tool to help unstick the housing market. Sellers get to advertise a rate that no one else can offer. The buyers aren't just buying a home, they're buying a low rate payment. It's an added feature of the home, just like a pool. It's the ultimate deal sweetener. Buyers save money every single month, every month for the life of the loan, and really everyone wins. Marketing a home as having an assumable loan can help it stand out in a crowded market. Sellers may still have to deal with higher rates when they're buying their next home, but they could potentially sell faster and for more money.
Recently, an independent group of economists actually found that when you sell your home with Realm, you not only get, say, $400K on your home sale, but actually you might be able to get as much as $420K or $430K, because buyers are willing to pay a premium for that additional low rate value proposition. And so the typical seller will get about 5% more for their home sale, and the typical buyer will still save $700 a month over the next 12 months, over the next 27 years.
At the end of the day, assumable loans are probably the best kept secret in real estate right now. I mean, a lot of agents don't know about them. They offer real savings in an environment where affordability is tough. If you're a buyer, ask your agent about assumable loan opportunities. If you're a seller with a VA or FHA loan under 4%, you might be sitting on the biggest marketing advantage that you didn't even realize that you had. And if you're not sure where to start, reach out to us at the Klaus team. We're happy to help you run the numbers, explore options, and let you know about all of the solutions that work best for you. For the properties that we mentioned in this episode, our sellers had no idea that their loans were assumable or that the loans would be something that we would market about their home. And we were happy to let them know about this extra tool in our toolbox. And we've got a lot more. We work hard to stay educated and to work with others to develop new tools, new tech, and new products to help our clients buy and sell real estate in new ways. If you want to find out how you can do more with the Klaus team than with anyone else, reach out to us at klausteam.com/callusfirst or call us at 480-354-7344, because in today's market, you don't need a DeLorean, but creativity and a huge menu of services sure helps. And thanks for watching or listening to this episode of the State 48 Homeowner Podcast. If you found it helpful, be sure to like, subscribe, and to share it with someone who's talking about buying or selling, or maybe somebody who thinks that buying a home is impossible because of the current rate environment. And hey, if you're ready to talk about assumables, we're here to help. Or if you want to find out how to cut $18,000 out of your spending this year, watch this episode 171, and we'll catch you next time on State 48 Homeowner. Thanks for spending time with us this week at State 48 Homeowner, the ins and outs of owning an Arizona home. You can connect with us for more information, submit topics you'd like us to further discuss. You can see relevant videos, give us feedback, answer your real estate questions, and more at state48homeowner.com.